The U.S. has confirmed that it will hike tariff on Chinese imports from Friday. The move is being touted as a fallout of the slow pace of progress made on true stocks that began months earlier. Global equities have faltered as a result, and commodities are no different, as heightened trade wars are never good for global economy, which isn't on a firm footing anyways. Joining us now from Sydney is David Lennox, resource analyst at Fat Profits, to talk about the implications of the same. David, good morning to you from India. Let's start about your reading on this particular tweet put out by President Trump and the implications, the very near-term implications of them.
Well, look, certainly, yes. The news that came out from the White House overnight was not good when it comes to looking at global trade, and especially that between the US and China. We are well aware that negotiations have been going on between those two countries for some time to conclude satisfactorily the trade war that is currently going on. It certainly does appear now that Donald Trump has upped the ante in terms of suggesting that should negotiations continue to delay or go on a slower basis, that we'll see a further implementation of tariffs on Chinese goods going into the US. That's certainly going to be very good for the US in terms of their terms of trade. But for China, any further lifting of tariffs is certainly going to put pressure on their supply of imports into that particular country.
What would this mean for individual resources? I mean, we've been all talking about how the biggest brunt will be borne by the metals pocket, and we've been seeing prices of that waver too. In India itself, companies with exposure have seen a beating, but our pricing pressure is going to continue.
Oh, look, there's no doubt about it that the base metals will probably bear the brunt of any change. It's primarily because of the rippling effect. China will deliver goods and services into the US. If those goods aren't delivered, then what we will see happen is the commodities required to manufacture those goods will obviously not be required, and that will cause a ripple back through to supply, and we will see lower supply. That's why the commodity prices have reacted in a negative fashion. And of course, you've got to remember, towards the end of last year, we did see a significant reaction in the equity markets globally. When markets believed that the trade talks were coming to a halt, then we saw that significant decline. So at the moment, it really is a matter of watch what Donald Trump is tweeting. If it is in fact his fair dinkum about implementing these tariffs on Friday, then it's going to be a disaster probably come Monday for the global equity markets and commodities.
The other point being, before this announcement, there was an anticipation that, met coal exports from US to China would increase and therefore have, a favorable outcome for steel pricing. But now if this pulls back and China has to revert back to Australian cargo, which is slightly more difficult for it, that could also wane in terms of the final product pricing going up because of the costs going up.
Oh, look, probably one of the commodities that's going to be slightly less impact would be iron ore, primarily because that goes into steel. And if China continues to stimulate its infrastructure building, which it has been doing, then we would expect that the demand for steel inside China would continue to be quite robust. Hence the demand for iron ore and for met coal, which is used in the manufacture of steel, would probably remain quite robust. However, of course, if China's terms of trade start to deteriorate, the reserves that they've built up from those particular positive terms of trade over the years would start to diminish. That means that they have less firepower to stimulate their own economies going forward. So really, it's going to be a matter of we've got to sit down and watch what happens, A, with the talks that are supposed to conclude or go on at the end of this week, and then what happens, obviously, come Friday when, if the talks are still somewhat hung up, that those tariffs aren't introduced.
The other point also being the Chinese oil refiners has already begun increasing purchases of U.S. crude, and they were readying U.S. LNG supply deals in the run-up to the trade talks and something meaningful coming out of there. Now that this has happened, what happens to that equation? Because the deliveries are slated for July. That doesn't change.
Well, look, certainly there's no doubt that anything that China can actually import from the US would certainly put Donald Trump in a better frame of mind, because that would allow the terms of trade just through the actual physical trading to adjust to a more positive or more neutral stance. So we would expect that China will obviously, and when you remember the first lot of tariffs that the US put on, China did retaliate. So one would expect that if this does happen, we will see China retaliate, and certainly in a lot heavier-handed way than they did the first time. Look, as we said with the first lot of tariffs, if there's a second lot of tariffs coming along, further goods are pulled into the net, then this is only going to end in tears for the globe.
According to you, David, with all the information at hand, what does it look like for global commodities? Does it look like it's going to be a cycle of pain across various commodities?
Look, certainly one of the real key drivers that has been dominating where commodity prices have been going right throughout last year and certainly this year has been the US dollar. It's been rising over the course of 2019, although it's somewhat volatile. That's really kept pressure on commodity prices from rallying to any great extent. If we see the US increase its tariffs and widen the goods that are captured under those tariffs, and those terms of trade start to improve a lot more rapidly than they have to date, then that's going to be very good for the US dollar. A higher US dollar, unfortunately, does spell disaster for commodity prices. So again, we could be in for a period of pain should Donald Trump go ahead and implement the additional tariffs that he's suggesting.
David, any gauge on crude oil prices? Fairly volatile, and in a short duration of time went from $75 per barrel on the Brent down to under 70. What are the initial signs looking like?
Look, certainly if you have a look at what's happening in the oil market, we've seen OPEC over the course of the last couple of data reads or monthly reads, and certainly the March read did show that they had been cutting production. They're now just over 30 million barrels. That's down from 30.5 million barrels from the month before reading. So from that point of view, OPEC is actually trying to put pressure on the upside when it comes to supply. The US itself, we saw domestic production inside the US rising from 12.2 to 12.3 at their last weekly read. So that's trying to just sort of remove some of that pressure that OPEC's putting on. At this point, we think OPEC's certainly not going to make any move to lower production. We believe that they'll wait at least until their main meeting in late June, which is their scheduled annual meeting, to determine what action they'll take. At this point, we'd suggest that the markets are probably relatively evenly balanced when it comes to demand and supply, and we've seen that commodity, or we've seen the oil price just reacting to that by hanging around somewhere around this US $70 for Brent.
Okay, David, just one final question. Despite all the upping of the ante from the US side, the Chinese delegation is still going ahead with the meet on Thursday and Friday. Could the markets be keeping one foot on the boat, which might be looking at a resolution, never mind how things sound right now, and therefore bracing for a bit of an uptick, a short-term uptick in the commodity prices should any announcement of that nature come out?
Well, look, there's no doubt about it that the first reaction to the market was negative, and that would be expected because the market had up until that point in time been getting used to the fact that we may see quite a successful conclusion to the trade wars. Of course, Donald Trump threw a pigeon in amongst, or a cat in amongst the pigeons overnight. So look, the markets are taking Donald Trump's tweet two ways. Is he fair dinkum? Or is he perhaps just trying to put pressure on the very fact that Chinese delegation is going to be in Washington in the course of the next few days and will be negotiating what the markets thought was going to be a conclusion, but perhaps not. So look, yes, I think the market's taking a bet each way. The initial reaction was certainly warranted, that uncertainty, but if there's some good news to come out of it, i.e. no further implementation, then we'll see a correction back pretty quickly.
Okay, David, we'll leave it at that. Thanks much for taking the time out and being with us today and giving us that perspective.